Diversify your portfolio. The three words every investor has heard countless times. The advice that supposedly protects you from financial ruin. But what if I told you that in 2008, during the great financial crisis, a fully diversified portfolio following all the traditional wisdom still lost over 40% of its value? What if I showed you that some of the wealthiest investors in history, Warren Buffett, Charlie Munger, Peter Lynch, have explicitly criticized over-diversification, calling it diversification? Let me ask you something. Have you ever bought an ETF while also holding individual stocks in the same sector? Have you ever invested in multiple target date funds simultaneously? Have you combined value investing strategies with momentum trading in the same portfolio? If you answered yes to any of these questions, you might be sabotaging your returns without even realizing it. The shocking truth is that approximately 89% of retail investors unknowingly combine conflicting investment strategies that actively work against each other. The result? Based on data from Dalbar's quantitative analysis of investor behavior study, the average investor has underperformed the S&P 500 by nearly 5.3% annually over the past 30 years, not because the market is unbeatable, but because their own portfolio is fighting itself. To understand why certain investment strategies clash catastrophically, we need to look at a real example. Meet Zachary Young, a software engineer from Seattle who did everything right, according to conventional financial wisdom. By age 35, Zachary had accumulated $450,000 across various investment accounts. He owned 3 different total market ETFs for sector-specific funds, a collection of dividend aristocrats, some growth stocks picked using technical analysis, and a small portfolio of value stocks selected using fundamental analysis. He also had 2 target-date retirement funds and a tactical asset allocation fund. On paper, Zachary looked well-diversified. In reality, his portfolio was a battleground where opposing forces neutralized each other's strengths. Between 2018 and 2022, while the S&P 500 returned approximately 60% cumulatively, Zachary's portfolio gained just 33%. That's nearly $120,000 in missed gains, enough to delay his retirement by several years. "I thought I was being smart by covering all my bases," Zachary later explained. "Nobody ever told me that some strategies are like oil and water. They simply cannot mix effectively." Zachary's situation is far from unique. Consider the case of Rachel Zimmerman, a 42-year-old healthcare administrator who inherited $275,000 from her grandmother in 2015. Following advice from 3 different financial sources, her bank advisor, a robo-advisor, and a financial podcast, Rachel created what she believed was a bulletproof portfolio. "I had a momentum strategy for my individual stocks, dollar-cost averaging into index funds, and a separate bond ladder my bank recommended," Rachel explains. "I was doing everything the experts suggested." The result? Inadvertent strategy conflicts created excessive fees, tax inefficiencies, and most critically, positions that directly canceled each other out. While the market gained approximately 85% from 2015 to 2021, Rachel's portfolio increased by just 52%. That's a performance gap that cost her over $90,000 in potential wealth. But before we dive deeper into these strategy conflicts, we need to understand something fundamental. What exactly is an investment strategy, and why do they sometimes work against each other? An investment strategy is not just about what you buy. It is a comprehensive framework that dictates how you select investments, when you buy and sell, how you weight different positions, and how you respond to market changes. Each strategy is built on specific assumptions about how markets work, what drives returns, and what constitutes risk. For instance, value investing, popularized by Benjamin Graham and Warren Buffett, assumes that markets occasionally misprice assets, creating opportunities to buy quality companies at discounts to their intrinsic value. In contrast, efficient market hypothesis adherents believe markets accurately price all available information, making index investing the most logical approach. These foundational assumptions matter enormously because they drive completely different behaviors. A value investor might hold cash waiting for market corrections, while an efficient market believer would stay fully invested at all times. If you try to follow both approaches simultaneously, you create internal contradictions that damage returns. This brings us to the critical question that will guide our exploration. If diversification is supposed to be the investor's best friend, why do certain diversification attempts backfire so spectacularly? And more importantly, how can we identify and avoid these dangerous strategy combinations before they derail our financial futures? To answer these questions, we need to examine some specific strategy combinations that create the most damaging conflicts. Let us start with what I call the active-passive paradox, simultaneously pursuing active management and passive indexing in the same asset class. Consider this real-world scenario. In 2019, a comprehensive study by Morningstar examined investors who held both an S&P 500 index fund and actively managed large-cap mutual funds. The research revealed that these investors paid an average of 0.65% in annual expenses across their combined portfolio, nearly 5 times what a pure indexing strategy would cost. But the higher fees were just the beginning of the problem. The active funds, in aggregate, underperformed the index by approximately 1.2% annually after fees. But here is where it gets interesting. When researchers isolated the specific stocks that differed between the active funds and the index, the active managers' bets, they found these positions actually outperformed the market by about 0.9% gross of fees. So why did the active funds underperform overall? Because roughly 70% of their holdings overlapped with the index, meaning investors were effectively paying active management fees on passive investments. The active managers' good stock picks were diluted by this massive overlap, while the index portion of the portfolio received no benefit from the active managers' research and expertise. It is like hiring an expensive personal chef but asking them to prepare the same frozen dinners you could heat up yourself, explains financial researcher Dr. Michael Richardson. You get the worst of both worlds. High costs with none of the benefits of true active management. This overlap problem becomes even more pronounced when we look at sector-specific investments. Data from a 2020 Vanguard study shows that the average investor holding both a total market fund and sector-specific ETFs typically has 30 to 45% position duplication. One participant in the study, a 38-year-old engineer, owned both the Vanguard Total Stock Market ETF, VTI, and the Technology Select Sector SPDR Fund, XLK. When researchers analyzed his portfolio, they discovered that his largest effective position was Apple, constituting over 8% of his total portfolio due to its heavy weighting in both funds. I had no idea I was so overexposed to a single company, the participant commented. I thought I was diversifying by owning different funds. This unintentional concentration risk directly contradicts the diversification principle that motivated the investment choices in the first place. When Apple experienced a 19% drawdown in late 2018, this investor's portfolio suffered disproportionately, precisely the outcome diversification is meant to prevent. But the problems with mixing active and passive strategies extend beyond fees and unintended concentrations. They also create psychological conflicts that lead to poor decision-making. Research from behavioral finance experts demonstrates that investors who combine these approaches tend to evaluate them on incompatible timeframes. They judge their index funds based on long-term performance, appropriate, but evaluate their active strategies based on short-term results, inappropriate. This temporal mismatch leads to constant portfolio tinkering and performance chasing, behaviors consistently linked to poor investment outcomes. According to Dalbar's 2022 Quantitative Analysis of Investor Behavior report, this behavior gap cost the average mixed strategy investor 3.6% annually in returns over the past decade, compared to a disciplined approach following either strategy consistently. Now, let us examine another catastrophic strategy conflict: mixing time-based strategies with valuation-based strategies. Time-based strategies, such as dollar-cost averaging and target-date funds, operate on the principle that consistent investing over time, regardless of market conditions, produces optimal long-term results. These approaches implicitly accept efficient market theory, the idea that current prices reflect all available information. In stark contrast, valuation-based strategies like value investing or tactical asset allocation assume that markets occasionally become irrationally priced, creating opportunities to buy low and sell high. These strategies require holding cash or defensive positions during overvalued markets and deploying capital aggressively during undervalued conditions. When combined, These approaches create fundamental contradictions. A real-life example illustrates this perfectly. During the late 2018 market correction, when the S&P 500 dropped nearly 20%, an investor named Thomas had a portfolio that perfectly embodied this conflict. His target date fund automatically maintained its 80% equity allocation, purchasing more stocks as prices fell, as designed. Simultaneously, his tactical allocation strategy, managed separately, was reducing equity exposure based on deteriorating technical indicators and high valuation metrics. I realized I was literally selling stocks with one hand and buying them with the other, Thomas later recounted. It was financial self-sabotage. This internal contradiction cost Thomas approximately 3.2% in annualized returns over the subsequent 3-year period compared to what he would have earned following either strategy consistently. More importantly, it created significant psychological stress as he constantly questioned which approach was right during market fluctuations. The research supports Thomas's experience. A 2021 study published in the Journal of Portfolio Management examined 3,200 self-directed investor accounts and found that those mixing time-based and valuation-based strategies exhibited 87% more trading activity and underperformed by an average of 2.9% annually compared to investors who maintain strategic consistency. But perhaps the most insidious strategy conflict occurs when investors combine momentum investing with contrarian approaches. Momentum investing operates on the principle that assets that have performed well recently will continue outperforming in the near future, essentially following trends. Contrarian investing, including classic value investing, operates on the opposite assumption, that markets overreact, creating opportunities to profit by going against prevailing sentiment. These strategies not only make contradictory assumptions about market behavior, but also require fundamentally different portfolio management techniques. Momentum strategies demand strict stop-loss discipline and rapid turnover during trend changes. Contrarian approaches require patience through extended periods of underperformance and the fortitude to add to positions as they decline. Consider the real example of Victoria, a marketing executive who maintained a retirement account following a contrarian value strategy while simultaneously trading a brokerage account using momentum principles. During the COVID-19 market crash in March 2020, her value strategy signaled extraordinary buying opportunities in beaten-down sectors like energy, financials, and travel. Meanwhile, her momentum approach triggered sell signals across the same sectors as they broke through technical support levels. I found myself writing passionate posts on investment forums about why airlines were incredible long-term buys while simultaneously selling every airline stock in my trading account, Victoria admits. The cognitive dissonance was exhausting. The performance impact was equally problematic. By the end of 2020, the conflicting approaches had created a 23% performance gap between Victoria's accounts and a simple balanced index approach, representing over $130,000 in opportunity cost. But these strategy conflicts become even more complex when we examine how they interact with risk management approaches. This brings us to another dangerous combination: mixing strategic asset allocation with tactical risk management. Strategic asset allocation, SAA, aims to maintain relatively fixed percentages of different asset classes based on long-term expected returns and correlations. This approach necessitates regular rebalancing, selling winners and buying losers to maintain target allocations. The underlying philosophy is that asset class returns revert to the mean over time. Tactical risk management, conversely, employs techniques like dynamic hedging, trend following, or volatility targeting to adjust exposures based on changing market conditions. These approaches often reduce exposure after losses to protect capital and increase exposure after gains to capture momentum. When combined, these approaches create perpetual conflict. Consider what happens during a sustained market decline. SAA principles would have investors buying more equities as they fall to maintain target allocations. Simultaneously, tactical risk management would signal reducing equity exposure to limit losses. The result is an expensive, tax-inefficient stalemate. This exact scenario played out during the 2020 pandemic crash for countless investors. One prominent wealth management firm reported that clients with mixed SAA/tactical strategies experienced 31% higher trading costs and realized 42% more taxable gains than those following consistent approaches, without any compensating performance improvement. As financial advisor Janet Robinson explains, these investors were effectively driving with one foot on the gas and one foot on the brake. They went nowhere fast, but they certainly burned a lot of fuel getting there. The data reveals something even more concerning. Strategy conflicts tend to multiply over time as investors add new approaches without eliminating old ones. A longitudinal study by financial planning firm InvestNet showed that the average self-directed investor adds a new investment strategy every 3.7 years but fully abandons an existing strategy only once every 8.9 years. This strategy accumulation leads to increasingly contradictory portfolios as investors age. By age 60, the typical self-directed investor in their study operated with elements of 4.7 distinct investment strategies, many with directly opposing philosophical foundations. This strategy creep explained why older investors, despite their greater experience, often achieved lower risk-adjusted returns than those with simpler, more cohesive approaches. But why does this happen? Why do intelligent, educated investors consistently build these contradictory portfolios? The answer lies at the intersection of information overload, financial marketing, and human psychology. In today's information environment, investors face a barrage of compelling arguments for dozens of investment approaches. Financial media, investment companies, and social platforms all compete for attention by highlighting strategies that have recently outperformed. These strategies often sound equally convincing in isolation, leading investors to adopt an and rather than or approach to their options. A 2022 study by financial psychologist Dr. Sarah Henderson found that 76% of retail investors believe they can successfully combine multiple investment philosophies without contradiction. When asked why, the most common response was that diversification of strategies offered the same benefits as diversification of assets, a fundamental misunderstanding that costs investors billions annually in underperformance. This brings us to a crucial question. If these strategy combinations are so destructive, why don't financial advisors and investment platforms warn against them more explicitly? The uncomfortable answer is that the investment industry benefits from strategy proliferation. Fund companies earn higher fees from specialized products than from simple index funds. Financial advisors can justify their services by constructing seemingly sophisticated multi-strategy portfolios. Financial media generates more engagement by constantly featuring new approaches rather than reinforcing consistent principles. The dirty secret of our industry is that simplicity works better than complexity, but complexity sells better than simplicity, admits a portfolio manager at a major brokerage who requested anonymity. Nobody gets rich selling the advice to pick one sound approach and stick with it for decades. This incentive misalignment has created an environment where strategy conflicts have become the norm rather than the exception. A 2023 analysis of robo-advisor portfolios found that 83% contained at least one significant strategy conflict, with 47% containing 3 or more. Even professional financial advisors weren't immune. 61% of examined advisor model portfolios contained at least one material strategy contradiction. But perhaps the most profound example of strategy conflict occurs when investors attempt to combine passive index investing with environmental, social, and governance (ESG) screening criteria. Passive indexing is built on the premise that markets efficiently price securities based on all available information, making stock selection futile. ESG investing explicitly rejects this premise, arguing that excluding certain companies based on non-financial criteria will produce superior long-term returns, or at least align better with investor values. Research from the University of Chicago examined investors who combined these approaches by holding both total market index funds and ESG-screened funds. The findings were striking. These investors effectively created portfolios with 92% overlap with the broad market, but paid an average of 0.34% higher annual fees. Even more concerning, the ESG screens caused these investors to inadvertently overweight certain sectors, particularly technology, while underweighting others, energy and materials, creating unintended factor bets that increased portfolio volatility by approximately 12% without improving returns. These investors thought they were making principled ESG allocations while maintaining broad market exposure, explains researcher Professor James Wilson. Instead, They created expensive, tax-inefficient portfolios with large unintended sector biases, getting neither the full benefits of passive investing nor the full expression of their ESG preferences. This brings us to a crucial turning point in our understanding of portfolio construction: the recognition that strategic consistency matters more than strategic sophistication. But how do we identify a coherent strategy and stick with it when financial media constantly bombards us with new, essential approaches? The answer begins with understanding that every successful investment approach is built on a clear perspective about three fundamental questions. 1. How efficient are markets? Are securities generally priced correctly? 2. What drives returns? Risk premiums, mispricing, or behavioral factors? 3. What constitutes risk? Volatility, permanent loss, or something else? Your answers to these questions should form a consistent philosophical framework that guides every investment decision. When you maintain consistency across these dimensions, strategy conflicts disappear. Consider Warren Buffett, arguably history's most successful investor. Buffett operates with a coherent philosophy. Markets are mostly efficient but occasionally mispriced securities, especially during periods of fear or euphoria. Returns come from identifying businesses trading below intrinsic value, and risk is the permanent loss of capital, not short-term price volatility. This philosophical clarity eliminates strategy conflicts. Buffett never combines momentum trading with his value approach. He never attempts tactical asset allocation while maintaining strategic target allocations. His approach has an internal logic that creates consistency across market cycles. The consistency of your investment philosophy matters far more than its specific content, explains portfolio manager Christine Anderson. A mediocre strategy followed with perfect consistency will outperform a brilliant strategy applied inconsistently. Data strongly supports this assertion. A landmark 2018 study by Morningstar tracked investors across various strategy types: value, growth, momentum, quality, indexing, and tactical allocation. The research found that while long-term returns varied somewhat between strategies, with a spread of approximately 2.1% annually, the most significant performance predictor was not which strategy an investor chose, but how consistently they applied it. Investors who maintained strategic consistency outperformed strategy switchers by an average of 3.7% annually, far exceeding the performance difference between the best and worst strategies themselves. Even more striking, the worst-performing strategy applied consistently outperformed the best-performing strategy applied inconsistently. This finding fundamentally changes how we should think about investment success. The traditional focus on finding the best strategy may be misplaced. The real key is finding a reasonable strategy that aligns with your beliefs about markets and risk, then applying it with unwavering consistency. But consistency alone isn't enough. You also need to ensure your chosen strategy actually fits your psychological profile and financial circumstances. This is where many investors go wrong, adopting approaches they can't stick with through difficult market conditions. Consider value investing, which requires the psychological fortitude to buy assets when they're deeply out of favor and hold them through extended periods of underperformance. Many investors are attracted to the historical success of value investing but lack the temperament to execute it effectively. When their value stocks drop 30% while the broader market rises, they abandon the approach, precisely when it's most likely to generate future outperformance. This pattern played out dramatically between 2017 and 2020, when value investing experienced its worst relative performance since the Great Depression. Data from Dalbar shows that over 60% of self-described value investors abandoned their approach during this period, just before value stocks began a significant recovery in late 2020. The solution is honest self-assessment before committing to any investment strategy. Research from financial psychology pioneer Dr. Daniel Crosby indicates that sustainable investment success requires alignment across 4 dimensions. 1. Philosophical consistency with your beliefs about markets. 2. Psychological compatibility with your emotional tendencies. 3. Practical feasibility given your financial circumstances. 4. Social sustainability within your personal relationships. When any of these dimensions is missing, strategy drift becomes almost inevitable, leading to the exact conflicts we've been exploring. Most investors choose strategies based entirely on past performance, or what sounds sophisticated, Crosby explains. They never consider whether they have the emotional capacity to execute the strategy through its inevitable difficult periods. This insight helps explain why simple, rules-based approaches often outperform more complex, theoretically optimal strategies. The simple approaches may be easier to follow consistently, creating fewer opportunities for self-sabotage through strategy drift. Consider the experience of Robert Quinn, a 45-year-old engineer who struggled with performance chasing for years. In 2017, after reading about the historical outperformance of small-cap value stocks, Robert allocated 40% of his portfolio to small-cap value funds. When this segment underperformed for the next 3 years, he grew frustrated and switched to momentum strategies focused on large growth stocks, just in time to miss the small value resurgence in 2021 to 2022. I realized I was always fighting the last war, Robert explains. I'd adopt a strategy after it had done well, stick with it until it underperformed, then switch to whatever had been working better, perpetually buying high and selling low. Robert's breakthrough came when he recognized that his psychological profile made him ill-suited for strategies requiring patience through extended underperformance. He ultimately adopted a trend-following approach that, while theoretically less optimal than some alternatives, aligned perfectly with his tendency to react strongly to short-term results. My returns immediately improved, not because trend following is inherently superior, but because it's the strategy one can actually stick with through all market conditions, he notes. This personalized approach to strategy selection represents a fundamental shift from the traditional one-size-fits-all recommendations that dominate financial advice. It acknowledges that the best strategy is the one you can execute consistently, not the one with the highest historical returns. But how do you identify which strategy best matches your psychological profile? Research suggests examining your behavior during past market extremes provides the most reliable indicator. How did you react during the 2008 financial crisis? The 2020 COVID crash? The 2021 meme stock frenzy? Your actual behavior in these situations reveals your true risk tolerance and decision-making tendencies far more accurately than any risk questionnaire. Once you've identified a philosophically consistent strategy that matches your psychological profile, the next step is ruthlessly eliminating conflicting elements from your portfolio. This often requires something surprisingly difficult: selling investments that aren't wrong but simply don't fit your chosen approach. This brings us to the concept of strategic pruning, the deliberate elimination of portfolio elements that, while potentially valuable in isolation, create conflicts with your core approach. Financial advisor Marcus Thompson describes this process as addition by subtraction. Most investors focus exclusively on what to buy, Thompson explains. The breakthrough comes when they start focusing equally on what to eliminate, not because those investments are bad, but because they create strategic contradictions. Strategic pruning requires overcoming the sunk cost fallacy and eliminating positions that represent different investment philosophies, even if they're currently performing well. This disciplined approach prevents strategy accumulation and maintains philosophical consistency across market cycles. A practical example comes from investor Eliza Morgan, who realized in 2019 that her portfolio contained elements of 5 different investment strategies accumulated over 15 years. After analyzing the philosophical foundations of each position, she eliminated everything that didn't align with her chosen core approach. Index investing with a small factor tilt toward value and quality. I sold several investments that had performed exceptionally well, Eliza recalls. Friends thought I was crazy, but I understood that their strong recent performance actually increased the risk that they would underperform going forward if they represented momentum or growth strategies, contradicting my core philosophy. Over the subsequent 3 years, Eliza's streamlined portfolio outperformed her previous approach by approximately 1.8% annually, not because she chose better investments, but because she eliminated strategic conflicts that had been creating self-sabotage. This process of strategic pruning leads us to the single most important principle for avoiding strategy conflicts: the need to create explicit investment rules before market extremes, not during them. The time to decide your investment philosophy is when markets are calm and you can think rationally, explains behavioral finance expert Dr. James Montier. The worst time is during market extremes, when emotions cloud judgment and lead to decisions you'll likely regret. Research confirms this insight. A 2021 study examining investor decision-making found that 82% of strategy-switching decisions occurred during periods of extreme market movements, either positive or negative. Of these decisions, 67% were subsequently reversed within 18 months, creating a devastating cycle of buying high and selling low. The solution is creating an investment policy statement, IPS, a written document that explicitly defines your investment philosophy, strategy selection criteria, and rules for portfolio management. This document, created during calm market conditions, serves as a commitment device that prevents emotional decision-making during market extremes. A properly constructed IPS addresses the three fundamental questions we discussed earlier: market efficiency, return drivers, and the nature of risk, and establishes clear rules for 1. Asset allocation ranges. 2. Selection criteria for specific investments. 3. Rebalancing triggers and procedures. 4. Conditions that would warrant strategy reconsideration. The key is that these rules must be internally consistent, all flowing from the same core investment philosophy. When properly constructed, an IPS eliminates strategy conflicts by creating a coherent decision framework across market conditions. Financial advisor Sarah Patterson shares the experience of clients who weathered the 2020 COVID crash with minimal emotional distress thanks to their previously established IPS. When markets plunged in March 2020, most investors were asking, "What should I do?" My clients with clear investment policies were simply asking, "What does our plan say we should do?" That subtle difference completely changed their experience of market volatility. The data supports this anecdote. A study by Vanguard found that investors with written investment policies were 60% less likely to make significant strategy changes during market extremes compared to those without formal policies. This behavioral consistency translated to approximately 1.5% higher annualized returns over the study period. But perhaps the most powerful aspect of maintaining strategic consistency is the compound effect of avoided mistakes over time. Consider two hypothetical investors starting with $100,000 in 1990, both utilizing a simple index-based approach with expected returns of 9% annually. The first investor maintains perfect strategic consistency for 30 years. The second makes just 3 strategy switches based on recent performance, each costing approximately 2% in relative performance during the transition years. By 2020, the consistent investor would have approximately $1.32 million, while the occasional strategy switcher would have about $1.08 million, a difference of $240,000 despite making only 3 seemingly minor adjustments over 3 decades. This enormous gap illustrates the profound impact of strategic consistency on long-term wealth accumulation. This brings us to a critical question. If strategic consistency is so valuable, why do even sophisticated investors repeatedly fall into the trap of conflicting strategies? The answer involves a psychological phenomenon called FOMO arbitrage, the mistaken belief that you can capture the best elements of multiple approaches without their drawbacks. FOMO arbitrage manifests when investors observe different strategies outperforming in different periods and attempt to combine them to capture the best of all worlds. This approach seems intuitively appealing but fundamentally misunderstands how investment strategies generate returns. Successful strategies work precisely because they accept certain types of underperformance to capture specific return premiums. Value investing endures periods of substantial underperformance during growth-led markets to capture the long-term value premium. Momentum strategies accept frequent small losses from false signals to capture large gains from persistent trends. Quality investing sacrifices maximum upside during speculative bubbles to provide better downside protection during crashes. When you attempt to eliminate these necessary periods of underperformance by combining contradictory approaches, you don't get the best of all worlds. You get diluted returns with higher costs, increased complexity, and psychological confusion. Consider a real example. During the 2010s, many investors observed the outperformance of both low volatility strategies, which performed well during market downturns, and momentum strategies, which captured upside during bull markets. Attempting to get the best of both worlds, they allocated to both approaches simultaneously. The result was predictably disappointing. When markets declined, The momentum positions dragged down overall performance. When markets surged, the low volatility allocations limited upside. Instead of getting the benefits of both strategies, these investors received the limitations of each while paying fees on both. The data confirms this pattern across strategy combinations. A comprehensive 2022 study by research affiliates examined 27 different two-strategy combinations across multiple market cycles. The researchers found that in 23 of the 27 combinations, the combined approach underperformed what would have been achieved by simply choosing the better-performing strategy and sticking with it consistently. Even more telling, 19 of the combinations underperformed both constituent strategies when measured on a risk-adjusted basis. Investors consistently overestimate their ability to identify which strategy will outperform in advance, explains research affiliates founder Rob Arnott. When they hedge their bets by combining contradictory approaches, they typically end up with higher costs, higher taxes, and lower returns than they would have achieved with either approach individually. This insight has profound implications for how we should structure investment portfolios. Rather than attempting to combine multiple approaches with different philosophical foundations, investors should 1. Select a single, coherent investment philosophy that aligns with their beliefs and psychological tendencies. 2. Structure their entire portfolio based on this consistent philosophy. 3. Accept that their chosen approach will sometimes underperform other strategies. 4. Resist the temptation to add contradictory elements during periods of relative underperformance. This disciplined approach requires accepting opportunity cost, the returns you might have earned had you chosen a different strategy that happened to outperform during a particular period. This opportunity cost is real and sometimes painful, but attempting to eliminate it through strategy combinations typically creates actual costs that exceed the theoretical benefits. Consider the experience of investor Michael Chun, who maintained a disciplined value investing approach throughout the 2010s while growth stocks dramatically outperformed. Michael's friends repeatedly questioned his strategy as companies like Amazon, Netflix, and Tesla delivered returns far exceeding his value portfolio. It was extraordinarily difficult to stay the course, Michael recalls. I constantly questioned whether I should add growth exposure to capture some of those returns. Michael ultimately maintained his strategic consistency, and when the market regime shifted in late 2020, his value approach began outperforming. More importantly, by avoiding strategy drift during the difficult period, he positioned himself to capture the full benefit of value's resurgence rather than switching at precisely the wrong time. The opportunity cost was real during the 2010s, Michael acknowledges. But by accepting it rather than fighting it, I avoided the actual cost of bad timing that afflicted many of my peers who abandoned value at the bottom and missed the recovery. This pattern of strategy switching at precisely the wrong time represents one of the most destructive investor behaviors. Data from Morningstar's Mind the Gap study demonstrates that the average investor underperforms the very funds they own by approximately 1.7% annually due to poor timing of purchases and sales. This timing gap is significantly worse for investors who maintain portfolios with mixed investment philosophies. When different segments of their portfolio respond differently to market conditions, these investors tend to focus on whichever segment is currently underperforming, creating constant temptation to adjust their strategy mix. This attention bias leads to a perpetual cycle of selling recent underperformers just before they recover and buying recent outperformers just before they revert. The solution is not just strategic consistency, but also what behavioral economists call strategic ignorance, deliberately limiting your exposure to information and options that might tempt you away from your chosen approach. The most successful investors I work with don't obsessively track the performance of strategies they've explicitly decided not to follow, explains wealth manager Jonathan Peters. They understand that constantly comparing their returns to what they might have earned with a different approach only creates psychological pressure that leads to poor decisions. This strategic ignorance extends to limiting consumption of financial media that promotes strategy switching. A revealing study by financial psychologists found that investors who consumed financial television programs daily made 41% more strategy adjustments annually than those who reviewed financial information weekly or monthly. These increased adjustments correlated with a 1.2% annual performance penalty. But strategic consistency doesn't mean never changing your approach. It means having explicit, predetermined conditions for when reconsideration is warranted. These conditions should focus on fundamental changes in market structure or personal circumstances, not recent performance. Financial advisor Elena Rivera recommends that investors establish tripwires in their investment policy statements, specific conditions that would trigger a formal review of their chosen strategy. These tripwires might include 1. Fundamental economic regime changes, shift from low inflation to high inflation. 2. Significant life events affecting risk capacity, inheritance, career change, health issues. 3. Persistent underperformance relative to expectations over full market cycles, not just short-term periods. The key is that these tripwires are established in advance when you're thinking rationally, Rivera emphasizes. They prevent both rigid adherence to a truly broken strategy and emotional abandonment of a sound strategy during its inevitable difficult periods. This balanced approach requires what investment strategist Howard Marks calls second-level thinking, the ability to distinguish between normal strategy underperformance and genuine strategy failure. First-level thinkers constantly switch strategies based on recent results. Second-level thinkers understand that every valid strategy will sometimes underperform and maintain consistency through these difficult periods. Perhaps the most powerful example of the value of strategic consistency comes from examining the performance of university endowments, particularly Yale University's endowment under the leadership of David Swensen. From 1985 to his passing in 2021, Swensen generated returns that outpaced those of other university endowments by approximately 3.4% annually. This outperformance wasn't the result of superior security selection or market timing, but rather of unwavering commitment to a clearly defined investment philosophy. While other endowments frequently adjusted their approaches in response to recent performance, Swensen maintained strategic consistency even through extended periods of underperformance. This consistency allowed Yale's endowment to capture the full benefit of their chosen strategy over complete market cycles, avoiding the performance penalties associated with strategy switching at inopportune times. The most important lesson from Swensen's success isn't about his specific allocation choices, explains investment consultant Laura Thompson. It's about his discipline in maintaining strategic consistency when others were abandoning their approaches. He understood that strategy switching is typically more destructive than strategy underperformance. This insight brings us to a fundamental principle that all successful investors eventually discover. The primary determinant of long-term investment success isn't selecting the perfect strategy, but rather avoiding major mistakes. And among these potential mistakes, strategy conflicts and inconsistency rank among the most destructive. As Warren Buffett famously observed, the first rule of investment is don't lose money. The second rule is don't forget the first rule. Strategic consistency helps investors follow this wisdom by eliminating the self-inflicted wounds that come from combining contradictory approaches or abandoning sound strategies at precisely the wrong time. This perspective fundamentally changes how we should think about portfolio construction. Rather than asking, what should I add to improve my returns? Investors should regularly ask, what elements of my portfolio create philosophical contradictions that might lead to strategy conflicts? This pruning mindset helps eliminate the strategy accumulation that plagues most long-term investors. It keeps portfolios focused on a single, coherent approach rather than a hodgepodge of competing philosophies. The practical implications of this insight are profound. For most investors, it suggests 1. Selecting a single core investment philosophy that aligns with your beliefs and psychological tendencies. 2. Constructing your entire portfolio based on this consistent philosophy. 3. Systematically eliminating investments that represent different philosophical approaches, even if they've performed well recently. 4. Creating explicit, predetermined conditions for strategy reconsideration that focus on fundamental changes, not recent performance. 5. Limiting consumption of financial information that might tempt you to abandon your chosen approach during its inevitable difficult periods. This disciplined approach requires accepting that your chosen strategy will sometimes underperform others. It means watching friends or colleagues temporarily achieve better results with different approaches. It demands the fortitude to stay the course when financial media is trumpeting the success of alternative strategies. But the historical evidence is clear. This strategic discipline, maintained across full market cycles, creates higher probability of long-term investment success than attempting to combine multiple approaches or switching strategies based on recent performance. As investor and author Nick Murray eloquently states, successful investing is about controlling the controllable. You cannot control market returns, economic conditions, or which investment style will outperform next year. But you can control strategic consistency, ensuring your portfolio maintains philosophical coherence rather than working against itself through strategy conflicts. The journey through strategy conflicts and their destructive impact leads us to a profound yet simple conclusion. Investment success comes not from complexity but from clarity, not from constantly adding new approaches, but from maintaining unwavering commitment to a single, coherent philosophy. This clarity begins with honest self-assessment. What are your core beliefs about market efficiency, return drivers, and the nature of risk? What investment approach aligns with both these beliefs and your psychological tendencies? What strategy can you realistically maintain through both bull and bear markets? Once you've answered these questions, the path forward becomes clear. Construct your entire portfolio based on this consistent philosophy. Eliminate investments that create internal contradictions. Establish predetermined conditions for strategy reconsideration. And perhaps most importantly, accept that your chosen approach will sometimes underperform others. This strategic consistency isn't always easy. It requires the discipline to avoid the siren song of recently outperforming strategies. It demands the fortitude to maintain course through periods of underperformance. It necessitates a long-term perspective when short-term results disappoint. But the rewards of this discipline are substantial. By eliminating strategy conflicts, you remove one of the primary sources of underperformance that plagues most investors. You position yourself to capture the full benefit of your chosen approach over complete market cycles. You create a sustainable investment process that can guide decisions through changing market conditions and emotional responses. Perhaps most importantly, you gain something invaluable: peace of mind. When your portfolio maintains philosophical consistency, you no longer face the constant doubt and second-guessing that afflict investors with conflicting strategies. You gain clarity about what to expect from your investments and confidence in your long-term approach. As we've seen, the most successful investors throughout history, from Warren Buffett to David Swensen, didn't achieve their remarkable results through constant strategy switching or combining contradictory approaches. They succeeded through unwavering commitment to clearly defined investment philosophies, even when those philosophies temporarily underperformed. In the end, the most powerful investment truth might be this: consistency beats complexity. Clarity trumps sophistication. And a mediocre strategy followed with perfect discipline will ultimately outperform a brilliant strategy applied inconsistently. The choice is yours. Will you continue combining conflicting approaches that sabotage your returns? Or will you commit to the strategic consistency that forms the foundation of long-term investment success? Remember, true diversification isn't about collecting contradictory strategies. It's about applying a single, coherent philosophy across different asset classes and market conditions. When you achieve this strategic clarity, you eliminate the invisible adversary hiding within most portfolios, the strategy conflicts that silently erode returns and prevent you from reaching your financial goals. The ultimate investment truth is this: you cannot serve two masters in your portfolio. Instead, choose one coherent investment philosophy and serve it with unwavering consistency, for this is the path to financial freedom.